Hello everyone, welcome back. Let's talk more about capital budgeting and the cash flow estimation side of capital budgeting. Basically we're going to talk about the capital budgeting process, project cash flows, and then estimating new venture cash flows, particularly with regards to that sort of terminal or salvage value, a little bit about CCA and a little bit about investment tax credits, just to make cash flows super clear. Now remember, we did this all together on that case that we did in class at the very last day together during the residential. So if any of this doesn't sound familiar, maybe go back to that Excel thing that we did together working on the capital budgeting mini case that we did together. Now, the capital budgeting process. So the idea is you've got these cash flows that you need to estimate. So easier to do for costs. They tend to be easier to estimate and just frankly more accurate. You also need to estimate cost savings, revenue, all of that. And revenue in particular is extremely hard to estimate well. Then you evaluate the estimates using decision criteria. So in other words, you take those estimates and you apply NPV or IRR or both to those cash flows to see what kind of answers you get for NPV and IRR. So people tend to just take whatever is given to them for forecasted cash flows, but of course they can be done well and they can be done poorly, and there certainly are lots of opportunities for errors. So let's go through the process and then some of those typical errors. So you need to forecast each cash flow and inflow during the life of the project, add everything up in each time period, and certainly if you're talking about starting a new venture that's a bit outside of your core business, that can be one of the most difficult things to estimate, particularly on the revenue side. Even the cost can be difficult. So there's the initial outlay that has to be determined, and it's not just the piece of equipment or whatever. There can be training costs, there can be setup costs. If you take it to the new venture idea, there's sort of the new venture itself in terms of leasehold improvements, incorporation, legal, those kinds of things. But there's also probably travel costs, communications costs, all sorts of different things that need to be estimated for that initial outlay. Then there's the sales forecast, what's going to be sold, how many of them, and what are they going to generate for revenue, cost of goods sold, assets, and changes in working capital to finance inventory, accounts receivable, less accounts payable. And then we need to calculate amortization, particularly CCA or capital cost allowance. So remember, and we covered this in class together, instead of amortization that we see in accounting, right, when we're amortizing or depreciating a fixed asset, in finance we tend to work with CCA or capital cost allowance as a stand-in for it. The reason is when we're working in finance, we're working with cash as opposed to accounting profit. And we need to figure out taxes because taxes are cash. So we need to figure out not just what are the income tax estimates, but what are we actually going to pay in income tax? In order to figure that out, we need to calculate the CCA or capital cost allowance on any assets that we purchase because those help us determine what we deduct from our profit to create our taxable profit, and then we apply our tax rate to that amount, and we can't do it without calculating the CCA. Then there's taxes and earnings and etc. So the rest is not as taxes. You guys have calculated those. We did those in the lab together. That was pretty straightforward. Now, expansion projects tend to require the same elements as new ventures, right? But replacement projects are saving costs, so we don't have to worry so much about generating revenue from scratch. Typical pattern: initial outlay, subsequent cash flows, and relevant project cash flows are incremental. What cash flows will occur if we undertake a project that won't occur if we left it undone? So do you remember when we talked about opportunity and sunk costs? So this is what we're getting into here. Sunk costs are costs that have already occurred and cannot be recovered. These are not included in our analysis because we can't unspend them. If you remember the mini case that we did in residential together, we worked on a piece of equipment that was like $10,850,000, and there were some costs of travel and feasibility that we ignored because we don't include costs that we can't unspend. There's no point in making a decision based on something that we can't change. So only future costs are relevant, but we do consider opportunity costs. If we've given up something to undertake a new project, revenues or cost savings, we do need to consider those if they're incremental, if they're different from whatever the two options are that we're comparing, maybe status quo to investing in this new project. So the opportunity cost of resources, the value in its alternative use, right? So, and we can talk about that as we go through it. So there's impacts on other parts of the company. There might be cannibalization, right? Diet Coke versus Coke Zero is a good example of cannibalization. So you have to consider that you're not just getting brand new sales without any impact on existing products. So if you're trying to decide whether to do Coke Zero, you estimate the revenue for Coke Zero, but you also estimate the revenue lost, to the Diet Coke revenue that will be lost when you launch Coke Zero. So margin lost in the other line is a negative cash flow for the project. Taxes are a cash outflow. We need to use after-tax cash flows, so we always have to be sure to deduct income tax when we're calculating. Now, working capital, when we ramp up revenue and we increase revenue for a product company, we generally need to invest in inventory and accounts receivable. And we get some benefit from accounts payable and having suppliers selling us inventory and maybe even some office supplies and things like that on credit. So we get cash flows from accounts payable, but it's a use of cash to invest in more inventory to achieve the greater sales, and it's a use of cash to invest in more accounts receivable so we can extend more credit to customers, whether it's additional revenue that's now going to be paid on credit, whether we are extending our credit terms out further, 60 days to 90 days or 30 days to 60 days. So all of those things eat up working capital, and we have to include that in our project when we're estimating the impact of the cash flows on the project. If we're going to increase revenue for a product, well, we're probably going to increase the amount of inventory that we have to carry too. And although the revenue is a positive impact on cash flow, that increased purchase of inventory up front so we can have the inventory on hand to get those sales, that costs us cash, and that's a negative use of cash, right? We ignore financing costs. Sorry for the noise in the background. We ignore financing costs because those are included in the discount rate, generally the cost of capital or the cost of capital plus some percentage for risk. Old equipment, if this is a replacement project, the old equipment can be sold. So that's another thing to consider. As an inflow, we don't just spend money buying the new equipment, we also get cash in from the Sorry about that, technical difficulties. So when we have a piece of equipment that we're replacing, we spend money on the new piece of equipment, but we also get immediate cash in from selling the old equipment. So we have to consider both of those. Okay, now let's talk capital cost allowance. Capital cost allowance is the amortization or depreciation that the tax authority, CRA, allows companies to deduct for tax purposes. We can choose whatever methods we want to amortize and depreciate fixed assets and tangible assets. For our financial statements, we can do what makes sense for us within the accounting guidelines, but Revenue Canada has very definitive opinions about what you do with different asset classes. And so we need to, when we're figuring out cash flows, figure out what the actual CCA deductions are or capital cost allowance deductions are before we figure out what our taxable income is. Now, here are the classes, some typical classes. Class 1 is buildings, for example, and you're only allowed to deduct 4% on declining balance. So in the first year that you buy a building, you would have, say, let's make it a ridiculous amount, a $100 building. So 4% of that, and you generally have half rate, remember, in that first year. That's one of the tricky things about CCA. So if it's a $100 building and 4% is the CCA rate as it is here for class 1 buildings, then you deduct 2% basically. So you'd have $100 opening balance, $2 worth of CCA that you would deduct on your income taxes for that year, and you'd end up with what's called a UCC, or undepreciated capital cost, of $98 left over at the end of the year. So then next year you take that $98 as your opening balance, you multiply that that by 4%. That is your tax deduction, and your UCC is $98 minus that 4%, so it's 96% of $98, etc., etc. And that's how you calculate declining balance CCA. Remember that half rate rule because that's an important norm in accounting for tax treatment on CCA. Straight line basis you'll see is allowed for class 13 and class 14. I think leasehold improvements class 13 you're allowed something like the length of the lease plus one renewal term, just as an example, and I think you're allowed a bit of discretion in that as well. So there's a straight line example, as opposed to, as you can see, a lot of other things on here are declining balance, which is pretty typical. Patents tend to be for the life of the patent as far as that goes. So that is what CCA is all about. And you can see here an example of the tax shield. So if the tax rate is 39% and we have an original item costing us $30,000, and so we've got a capital cost allowance of 30%, but in the first year we just take half of that. So we take $30,000 times 30%, but one half of that we get $4,500 for the CCA. And you can see the UCC, the undepreciated capital cost, is $30,000 minus $4,500. So now we have an opening balance next year of $25,500. So that's the column that you're seeing run down. Now if we look to the right, what that's doing is it's taking the $4,500 CCA, capital cost allowance, and multiplying it by the tax rate of 39%. And it's saying, you know what, there's a tax shield of $1,755 because we have this taxable allowed expense that we can deduct against revenue. So we're taking $4,500 of revenue and we're shielding it from income tax by having a deduction that we can claim against that revenue, and the total value of that tax shield is $1,755. You'll remember for the mini case that we did together, there was two ways of calculating the cash flows. One is to simply say, okay, well, let's work it all through, deduct the CEA. Now we've got our taxable income. Let's multiply by our tax rate. Okay, there's our taxes now. Okay, let's add back in the CCA because that's non-cash. So we can kind of do it step by step. A faster way of doing it is to say, okay, well, what's the value of the tax shield? How much cash are we saving because of the tax shield? And that's what this is showing us here. And that was the one, I don't know if you remember on the Excel spreadsheet, but the one that we did together working it through step by step was on the right, and then the tax shield variation one, the faster one that's maybe a little less intuitive, was on the left of the Excel spreadsheet when we worked through that. So again, when an asset is purchased, there's a half-year rule that says we only take half of the CCA. That's because it's assumed that some of the assets will be purchased at the beginning, some at the end, some in the middle, so they're all going to be deducted as if they were purchased halfway through the year, because that's the average of what occurs. The UCC is a pool of assets. It's not individual assets. So each class generally has a pool. In other words, all of the buildings, all of this class 1 buildings are in class 1. It's a whole pool of buildings basically, and that's how it's typically treated. Okay, when the asset is sold, the lower of the sale price or the original cost is deducted from the pool. And if the asset is sold for more than the original cost, you have to recognize a capital gain for tax purposes. So corporations must pay capital gains on assets that are sold if the asset is sold for more than its original cost. Now, only 50% of the capital gain is added to the taxable income for the year, and then the tax rate is applied to that. There's no capital losses for tax purposes. CCA tax shield is the tax savings, as I said, from deducting the CCA. And for capital budgeting purchases, it is a cash flow. So we need to calculate the present value of the tax shield. So this is the same example as we saw in the other screen. And here's the formula if you prefer that version of calculating what's going on with a capital budgeting project. And this is the same kind of information on the CCA tax shield. I like this last slide. I think it's a very good checklist actually when you're doing, when you're working problems when it comes to, and many cases for that matter. It really identifies things that you include and exclude well, I think, and in capital budgeting. You'll notice it's got sunk costs excluded, it's got past expenditures excluded, interest expenses is excluded. It's a good summary. I think that's very helpful. And that is the end of this chapter.